Day trading can be extremely thrilling because you can make or lose $1,000 in the same day. And with swing trading, you can make or lose thousands of dollars overnight.
We're all gonna be rich!
I've made and lost money using both of these strategies, so in today's video, I'm going to be comparing day trading versus swing trading. I'm going to go over the pros and the cons for each of these, and at the end of this video, I'm going to try to help you decide on which one is the best fit for you. Now, the difference between day trading and swing trading is pretty obvious. Obviously, day trading is meant for same day trades. So you open and close a trade on the same day. And the great thing about this is that it can be very quick and easy money if you know what you're doing and with a little luck on your side. But in that same note, you can also lose money very quickly with day trading if you're wrong about your trades. So actually, I kind of see this as a benefit even if you lose money. And the reason for this is because day trading gives you a lot more liquidity. So it allows you to get in and out of your trade more quicker than if you are swing trading, because if you're holding a position overnight, that's cash that could have been spent on opening a day trade. We'll talk about that later whenever we get to swing trading. But the next pro whenever it comes to day trading is that you get to avoid the wild overnight swings in this market, especially whenever it comes to really big events such as Fed meetings or such as earnings reports or economic data that's coming out. You can avoid these really big events that happen in the after hours or in the pre-market usually. So if you can avoid that, then you're going to avoid the volatility that comes with that big event. So this means that you won't lose as much money guessing the wrong direction on these big events. With day trading, it's less so focused on events that you're looking out for, and it's more so focused on determining trends in the market. So you're determining whether the stock market is going up or going down, and you can use technical analysis in order to do this. So if you're more well versed in technical analysis, price levels, patterns, moving averages, things like that, then day trading is going to be a better fit for you. So that's another pro whenever it comes to day trading. It's more technical analysis and trend based than it is with fundamentals and news. But the cons whenever it comes to day trading is the opposite to what I first mentioned. You can make a lot of money whenever you're day trading. You can make it very quickly, or you can lose a lot of money very quickly, and especially whenever it comes to options trading, because with options trading, it's not anything like stocks, because the likelihood of a stock going to zero in the same day is extremely low.
60% of the time, it works every time.
With an options trade, it's much more likely that that option is going to lose all of its value in the same day if you're day trading it than it is for the stock to lose all of its value in the same day. So you can lose your money extremely quickly if you don't understand risk management whenever it comes to day trading options. So this is something that I would definitely nail down. You have to be more risk adverse whenever it comes to day trading. So this is one of the cons. And the next con whenever it comes to day trading is that I think it requires more time commitment. You have to be kind of glued to the screen, watching the price charts, watching the trend, which way the stock market is going. That way you can determine when to enter and exit your trades. Whereas with swing trading, you're waiting for the overnight swings and you don't have to pay as much attention whenever it comes to the charts. But there is a solution for this, obviously. If you have a broker like Thinkorswim, they will send you alerts for whenever a stock goes above or below a certain price. So price alerts are extremely useful in getting rid of this con. And the last con whenever it comes to day trading is the PDT rule, or the pattern day trade rule. And what the pattern day trade rule says is that you can only make 3 day trades per week if your account is below $25,000. So if you have a small portfolio, then this would be a con for you. But there are plenty of ways that you can work around the pattern day trade rule. So I'm going to give you just a few examples of how you can avoid it. So the first way is to open up a separate broker. So whenever you open up a separate broker and put money into that brokerage, then now you get 3-day trades from one app and then 3-day trades from the other app. So now you have a total of 6 day trades available to you through your 2 different brokerages. And this is one of the ways that I've avoided the pattern day trade rule over the last few months. Whenever I run out of day trades on one account, then I'll switch over to the other account. And another way that you can get around the pattern day trade rule is by switching from a margin account to a cash account. And the difference between these is a margin account will allow you to trade almost instantaneously. For one, you don't have to wait for your deposits to hit when it takes a couple days for them to go through. 2, you don't have to wait for your money to come back after you make a trade, because whenever you close a trade, it takes T, or the trade, plus 2 days in order for your money to clear in order to open a new trade. But with a margin account, you avoid this. With a cash account, you can't avoid this. So this is one of the drawbacks of having a cash account versus a margin account. I'll probably cover this in a more detailed video later on, but these are a couple ways that you can avoid the pattern day trade rule. Again, setting up a cash account versus a margin account, but you will be giving up liquidity, waiting 2 days for your money to clear. Or you can set up 2 brokerage accounts. That way you can make 6 day trades per week. Another way that you can avoid the pattern day trade rule, though, is to just not day trade, hold overnight, or do swing trading. So let's talk about swing trading, the pros and the cons for this. The pros whenever it comes to swing trading is that you can make a lot more money. And the reason for this is because whenever a stock has a big event like an earnings report, there's more volatility around those large events. So if you're right about the trade, then you make more money accordingly. So these overnight swings can help you to make more returns than you would with day trading. But obviously, this can work in the reverse direction, and this can go into the cons if you're wrong about your swing trade. But again, this is really great for big events like earnings reports and things of that nature that are going to move the stock market in a really big way, because you can capitalize on those overnight events that are happening in the after hours or the pre-market. So that's another pro whenever it comes to swing trading versus day trading. You're more focused on the events that are happening than you are with the trend for that stock, because overnight, if there's some big event, then that trend can obviously be broken. So this is more for events-based traders, whereas day trading is more for trend-based or technical analysis-based traders. And I would say this is really where my edge is whenever it comes to trading, is predicting these big events, which direction the stock is going to go. And obviously, I'm going to get some wrong every now and again, but overall, my win rate is 70%. So I would say that I'm pretty good at guessing what's going to happen at these events and how the stock is going to react. And the last great thing whenever it comes to swing trading is that you get reduced time decay, because if you're doing a day trade and you're doing 0 data expiration options, that option is going to lose all of its extrinsic value or its time value the same day that you opened it, if there's no days until expiration. But if you're swing trading, then you have the option to set your expiration date for the end of the week. So that way, the theta value is going to be lower than if you were to open it the same day that the option expired. And you could also use leaps options, because swing trading isn't just about, buying one day and then selling the next. You could hold these trades for a couple weeks with a monthly expiration date, or you could even hold these trades for months or even years if you're buying a leaps option. So swing trading gives you a little bit more options whenever it comes to choosing your expiration date, and it has less time decay accordingly. But there are some negatives whenever it comes to swing trading, so let's talk about those. The first con whenever it comes to swing trading is that risk management is even more difficult. And the reasoning for this is because you're holding these options overnight. You don't know which way the stock is going to go definitively. So if you're wrong about the trade and the stock makes a huge move overnight that's against the way that you thought it would go, then obviously you can lose money more quickly than you would with a day trade. Because with a day trade, you're always watching what the stock is doing. You're watching the trend, technical analysis, but trends and technical analysis can be completely erased by a big earnings event or something of that nature that's moving the stock in a really big way. So risk management is more difficult whenever it comes to swing trading versus day trading. So this is the first con. And the next con is that swing trading comes with a bigger learning curve. So I would say that technical analysis is pretty simple, at least the way that I like to use technical analysis. I don't use trend lines or moving averages. I only use price levels because I like to keep things extremely simple. I look at price levels and sometimes I'll pay attention to volume because the more volume that's going into a stock, obviously the more that stock is going to move if there's more buying pressure or more selling pressure. So I don't use a lot whenever it comes to technical analysis, but with swing trading, you have to understand the fundamentals of the market. So what's moving the market in different ways. So you have to understand earnings reports if you want to trade around earnings reports, and you have to understand what the big events like Fed meetings and economic data and how they affect the rest of the market. So again, there's a much larger learning curve whenever it comes to swing trading versus day trading. And the last con whenever it comes to swing trading is liquidity. I talked about this a little bit in the beginning whenever we talked about day trading, how day trading is extremely liquid because you're getting in and out of the trade at the same time. But with swing trading, you're holding overnight, so you're using that cash up that could be available to make other trades. And this is especially the case with very long-term trades. This is something that I actually had an issue with recently and how I blew up my account, sending it from $3,000 to $9,000 and back to $3,000, losing everything. And the reason for this is because I tied up pretty much all of my money into just two trades. I had a SPY leaves put option, and then I had a Zillow large short position. So these two trades made up $6,000 of my $9,000 portfolio, which meant that I couldn't make many other trades elsewhere. I could only make maybe one or two trades at best. So this was holding me back, and this is a problem whenever it comes to swing trading, especially longer dated trades. And liquidity is incredibly important whenever we have a extremely volatile market like we're experiencing right now. You want to be able to get in and out of opportunities extremely quickly to deal with the volatility. So that's the last con whenever it comes to swing trading. Now, finally, for the last part of this video, let me help you decide on which one is better for you, day trading or swing trading. So day trading, I would say, is more beginner friendly. Again, this is based on technical analysis and trend lines, which I feel like is easier to learn than learning fundamental analysis, learning how economic data affects the stock market, and learning how earnings reports affects individual stocks. So again, there's more of a learning curve whenever it comes to swing trading. So day trading is more suited for beginners, and it's also more suited for people that are good at technical analysis and trends. So if you've become accustomed to using technical analysis, if you understand the charts really well, then day trading would probably be the better of the two options for you. And the last reason why you might choose day trading versus swing trading is if you're very much growth oriented in your portfolio. Because with day trading, you can somewhat make consistent profits because you're trading every single day. And, if you find a routine to where you're making a decent amount of profit, say every other day, then you'll grow your portfolio a lot quicker than somebody that's swing trading and dealing with the overnight swings and probably losing money because of a couple of wrong trades. Whereas with day trading, again, it's more manageable. It's more liquid, which means that you can get in and out of your trade quicker and before you realize a huge loss that would be experienced in an overnight trade. But that doesn't mean that swing trading is completely useless. I would say that swing trading is for people that are more advanced in their trading, people that understand, say, economics and, again, how earnings move stocks and understand economic data, how the Fed moves the stock market. So if you have a good understanding of the economy and what affects the stock market, then swing trading is probably going to be the better of the two picks because you can determine how the stock is going to move overnight based on your best guess of what's going to happen on the event. So swing trading is probably more for event-based trading, whereas day trading is more based on technical analysis and price levels. And the second reason why you might choose swing trading versus day trading is if you're more risk friendly, if you're able to stomach, the 5, 10, even 20% drops that some of these stocks have seen on their earnings reports. If you're able to stomach that volatility and you're more risk friendly, then swing trading is going to be the better of the two picks. And I would say that swing trading probably provides more gains in the long term if you have enough luck on your side and if you're good enough at determining how events will change the stock market. But in the short term, if you're looking for growth, then I would say that day trading is probably the better of the two. And that's all the reasons that I can give on why you might choose day trading versus swing trading. Maybe you have a few others. Leave them down in the comments if you have anything. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.